Hi folks, welcome back to Meaningful Money. Today I'm going to be talking about life assurance. Do you remember last time we introduced the three things primarily that we need to ideally protect against? Depends on your situation, but those three things are life assurance, what happens if you die, critical illness, what happens if you get something nasty but don't die, so things like cancer, heart attack, stroke, and then what happens if you're just ill, not critically though, and so are unable to work. Life, critical illness and inability to work, income protection. So today we're going to talk specifically about life assurance. So this is stuff, policies, products which pay out a sum of money in some form or other if you die. Now, there's no middle ground here, you're either dead or not, so one life assurance policy is broadly as good as another, because there's only one risk we're talking about, and that is if you die. Alright, pretty clear. Now, there are two broad types of life assurance. The first of these we would call term assurance, and it's called that because you insure your life for a fixed period of time, from now till then. Now that term is set by you and is usually, for instance, to cover a mortgage. If you've got a 25-year mortgage, you could have a 25-year life assurance policy. Or maybe you've got very young children and you want to protect your life until they become financially independent, say at age, well, 50 probably, but let's say 21 or 25. So you protect your life for a fixed term. Now the alternative to that is what we call whole of life assurance, and as the name suggests, instead of having a fixed term, you take off the end point and you just have a policy which runs for the rest of your life. Now, the difference between those two is the chances of a payout. Remember, insurance, take car insurance for example. Insurance is based on the premiums of the many paying for the claims of the few. So out of the millions of drivers who are insured in this country, a small percentage will actually claim in any 1 year, and that keeps the cost down for all of us. Don't feel like it. I had my renewal recently, but anyway. Now term assurance does the same thing. Now I'm 35, so let's say I have a 20-year life assurance policy. That'll take me until I'm 55. Well, the chances of me dying between 35 and 55 are very slim. I'm in reasonably good nick, carrying a couple of extra stone, but the chances of me dying are slim. Therefore, premiums are quite low on term assurance. That leads me on, obviously, to the fact that the cost of life assurance depends, firstly, on your age, secondly, on your health. If you apply for life assurance, you'll have to answer medical questions, so if there are medical issues, that could increase your premium. Thirdly, on your gender. Statistically, of course, women live longer than men, so they get cheaper life assurance. They pay a little bit more, though, for critical illness cover and income protection, because they're generally more complex creatures, and often more things go wrong with women than men. But anyway, I shall leave that there. Now, let's take this term assurance. It's cheap, but there are three broad categories underneath term assurance. Right? First one is called level term assurance, and as the name suggests, it's not the term which is level, it's the amount of payout that you set stays the same for the entire term. So for instance, I have a level term assurance policy. It's designed to last until I'm 65, and it's for £500,000 as it happens, and it only costs me 32 quid a month, which, if you think about it, is crazy. £500,000 potential for 32 quid a month. But that £500,000 stays the same. So if I die 1 day before the end of the term, 1 day before my 65th birthday, I will still receive a £500,000 payout, or rather my wife will, my widow. So level term assurance, the sum assured, which is the amount of payout, stays the same for the whole term. Secondly, you can have decreasing term assurance. If you have a mortgage on a repayment basis, the amount you owe to your mortgage lender goes down over time. And a decreasing term assurance is designed to do the same thing. So the amount of cover starts high, usually at the amount of the mortgage, and goes down over time. So that by the end of the term, designed to coincide with the end of your mortgage, there's no cover left. So if you die after year 15 of a 25-year policy, there's enough in the life assurance policy to pay off however much is outstanding in the mortgage at year 15. Decreasing term assurance, the amount of cover goes down over time. The third main type of term assurance is something called family income benefit. The previous two I've just talked about pay out a lump sum. So my policy my widow would get £500,000 paid out as a lump sum. Now sometimes that can cause as many problems as it fixes. So a family income benefit seeks to get around that by, instead of paying a lump sum, it pays a regular annual benefit, say £40,000 a year. Can you see how that is also a decreasing term assurance? Because if I've got a 20-year policy which pays, say, £10,000 a year, let's make the figures easy, then if I die at day one, then that's going to pay £10,000 a year for the next 20 years, so £200,000 in total. But if I die at the beginning of year 11, then there's only 10 years left, then that's only going to pay £100,000 out at £10,000 a year over the 10 years. So it's a decreasing term assurance because the amount of payout reduces over time, because we've got this end point at the end of the term. So you've got level term assurance, decreasing term assurance, and family income benefit, which pays a regular annual amount instead of a lump sum. Now, which one of those best suits you will depend on your circumstances. If you have a mortgage, then if it's a repayment mortgage, then probably a decreasing term assurance will be useful for that. If you have an interest-only mortgage where the amount stays the same and you're saving into an ISA or an endowment or something to pay it off, then there's some merit in having a level term assurance. If the thing you are you're desiring to protect, so for instance in the case of my policy, I have one for the mortgage, but we have this separate one, this big one, and really what I'm aiming to do there is to protect or to replace my contribution to the family. It's probably woefully undervalued actually. But if I die tomorrow, then my earnings potential has disappeared overnight, which means my wife then would need to work, we need to pay childcare while she's doing that work and all sorts. So my £500,000 policy is designed to make their life a little easier in the event of my sad demise. Right, so that's term assurance. The other side of the coin, remember, is whole of life assurance, where the policy continues until the policy continues until the end of your life. There's no end point. Just a lady going past on a horse there, giving me funny looks. That'll teach me to do these in public. Now, whole of life assurance is expensive, needfully so. Remember, if insurance is based on the premiums of the many paying for the claims of the few, well, unfortunately, folks, 1 in 1 people die. We're all going to meet our maker one day, shuffle off the mortal coil, and that means that potentially at least every whole of life policy written is going to pay out. Now of course it doesn't, people surrender their policies or cancel them early, but potentially at least every whole of life policy has the potential to pay out. I think what I'm going to do is end this one here, and I'm going to cover whole of life in the next video, because there's a little bit more meat to it and I don't want these videos to be too long. So effectively we've dealt with term assurance this time. So remember, level, decreasing, family income benefit. There are some rarer alternatives, convertible term, which when you get to the end point enables you to convert the policy into something slightly different. Or renewable term, which means at the end of the term you can carry on the policy, but usually recalculated the premiums because you'll be older and things like that. So which one of these best suits your purpose is a perfect excuse to go and see a decent financial advisor, because they will help you in that and be able to search the market for the best stroke cheapest option. So that's term assurance. Tune in next time and we'll talk about whole of life. Thanks a lot.